and welcome to episode number 63 of Let's Talk About Options. Obviously, we are not doing this video live today. We have done this video live, and there was some technical glitches. So we said, okay, let us redo this video at the end of the day. So sorry, you may not be able to give live comments, but you are most welcome to write your comments, write your feedback in the comment section once this video gets uploaded. As I said, there is a lot of confusion running. We are getting a lot of queries about the margin requirements, whether the margin calculations have totally changed, or is there something which is need to be considered before selling options. Obviously, we need margin requirements are for selling options, for buying options. Please do not get confused. There are no margin requirements. When you're buying an option, you need to pay money which is equivalent to the premium of the option, which is equivalent to the price of the option. But when you want to sell options, you need to keep a margin with the broker. If I give you an example, suppose you want to sell a call option, whether that call option is worth 50 rupees or 60 rupees or 100 rupees, you need to keep 50, 60,000 rupees with your broker. He will block that money. Only then he will allow you to sell the option. So the money which is blocked is known as margin. Once you secure of that option, that margin will come back to your account, and whatever is the profit or loss, that will also get adjusted. Now, there was a circular by exchange in the month of September that in a phased manner from September and then in October and then in November, there will be changes in the margin requirements of different options. After that, there have been some amendments to that circular also. So accordingly, now it has become a very interesting play, uh, because if you understand the proper margin calculations, then it will be much more easier for you to select the right kind of strike prices based on what kind of profits you are looking for. So that is why we said, okay, let us make it slightly more clear to all our subscribers that okay, what how margin calculations are now impacting your profits. Remember, if the margin requirement to sell an option is more, obviously the profit available will be less. If I give you in a different way, let's say you have 5 lakh rupees in your account, and for selling one option you need to give a margin of 1 lakh rupees. So maximum you will be able to sell five options only. Now, if you are able to sell five options, or let us say you are able to sell five lots, then your profit will be maximum equivalent to premium of those five options. But suppose if the margin required to sell an option is 50,000 rupees, now in 5 lakh rupees you will be able to sell 10 lots or 10 options. Now the possible profit is equivalent to the premium you have received by selling 10 options compared to the premium received by selling five options. So margin requirement is basically the denominator. It is basically your investment. On that investment, whether you are getting sufficient returns in terms of premium or not, uh, uh, that is dependent upon how much margin you need to pay for selling a particular option. Let us try to understand this with an actual margin calculator. And this margin calculations are done at the end of the day after today's closing. Today's closing is roughly around 10,582 plus minus a few points here and there. Now here what I have done, I have selected product as options. I have selected the option of call of expiry 29th November Nifty, and I have chosen strike price of 11,000. If I sell one lot of 11,000, the margin requirement is 48,459 rupees. This is the amount of margin I need to uh, get blocked with the broker to sell this option. Now, if instead of 11,000, let us say I want to sell a strike price of 10,900. Let us see that. If I'm trying to sell a strike price of 10,900, same Nifty, same expiry call option only, the margin requirement is 49,138 compared to 11,000. 11,000 was 48,459. This is 49,130, roughly around 600 rupees more, because market is at around 10,582. From 11,000, I am moving towards 10,900. As I'm moving towards the spot, my margin requirements are increasing. In this case, the margin requirement has increased slightly, just by 600 rupees. Now, if I go to, let us say, 10,800, this becomes interesting. If I go to 10,800 strike price and want to sell a call option of 10,800, same Nifty, 29th November, the margin requirement is 53,631, which is almost 5,000 rupees more compared to 10,900. Since I am moving closer to the spot, my risk is increasing, so my margin requirement is also increasing. Let's see 10,700. See this 10,700, the margin requirement has become 58,817. 58,000 vis-a-vis 10,800 is 53,000. This is 58,000. So more than 5,000 rupees margin has increased if I have shifted my position from 10,800 to 10,700. This is very, very critical to understand, because when you are trading in options with a trading plan, many times you need to do some adjustments wherein you're squaring off one position and you're selling a different position. So when you're selling a different position, obviously you must have one eye on what will be my new margin requirement, whether that margin requirement is going to go up or whether that margin requirement is going to go down. So 10,700 requires 58,817, whereas 11,000 requires only 48,000, a difference of 10,000 rupees within 300 strike prices, right? Let's see 10,600. If I see 10,600, see the jump. The margin required is now 64,768. Because market is almost at 10,600, the margin requirement is has increased like anything. Uh, just to clarify, we are calculating all these margins at the end of the day when markets have closed. Tomorrow, when markets open, there can be a small difference between whatever is the requirement in margin. 64,768 may become something like 66,000 or 63,000, depending upon where is the market, what is the volatility of the market, right? So roughly these will be the figures. So 10,600, you require 64,000 rupees. And if I go to 10,400, which is slightly in the money, you see, 10,500, sorry, 10,500, which is slightly in the money, the margin requirement is more than 71,000 rupees. See the difference. If you're selling 10,500, margin is 71,000. If you're selling 11,000 call, the margin requirement is only 48,000. Now, this becomes a very, very important aspect in managing your positions, because this becomes very important. Everybody has limited money. Within that investment, within that money, I need to manage my positions in such a way that I get the desired results. So if I'm saying, okay, let us say if I'm selling a 10,900 call, if in selling 10,900 call, I'm, let us say, blocking a margin of 49,000 to 50,000 rupees. If I want to make 4% of 50,000 will be 2,000 rupees. So if I'm getting 2,000 rupees as a premium, can you see there is a premium receivable? In this case, the premium receivable is 1,628 rupees. So which is more than 4%, right? In this case, even if I sell this 10,900 call and I receive a premium of more than 4% on my investment, and market expires below 10,900 by 29th of November. Remember, we are doing all these calculations on 13th of November, when only 16 days are left for expiry, not the whole month, right? So what has happened with this new structure of the market, that it has become more beneficial for option sellers. Even at a huge gap from the spot, you're getting more than 5, 6, 7% kind of a premium to sell, and market may not touch those levels, and that can be a decent profit which you can make. But only thing we need to see is that, okay, uh, all these positions are hedged and you have a proper adjustment plan in place, without which it will be very difficult. So I'm not recommending that just go and sell this 10,900 call and you will make 4% in next 16 days. That is not the recommendation. You must know what will you do in case market goes up, what will you do in case market goes down. So and again, as a caution, option selling can give you unlimited losses also. So you should be very, very cautious. You must know the complete concept. In this video, I'm just telling you, okay, what has changed with the requirements of margins. I'm not at all recommending any of the trades. Now, this is about calls. Let us see what has happened in case of put side also. So, frankly speaking, there is no increase in margin. If you're selecting your strike prices correctly, there is nothing to worry. In fact, market has become much more fruitful for option sellers. Okay, I have selected Nifty 29 November. I am selecting put, and let's say I'm putting a strike price of 10,000. 10,000, and I'll say sell and add For selling 10,000 put, the margin required is 50,000 rupees, and in 50,000 rupees, you're getting 2625, which is more than 5%. Market is at 10,582, right? Even if you're selling an option which is 600 points below market, 6% below market, you can still make more than 5% in next 16 days. But focus is that okay, margin requirement is 50,000 for 10,000 call, 10,000 put, sorry. Let us see what happens to 10,000, let us say 10,200. What is there a substantial difference? Again, I'll put here as Nifty, here as put. 10,000 we have seen is 50,000 rupees. Let us say 10,200. I'm coming closer to the spot. The margin requirement should increase. Okay, the margin requirement has increased roughly by 3,000 rupees. It is 53,361, and your receivable is also increasing. Let us see what happens if I come closer. If I come to, let us say, 10,400 put, uh, whether the margin requirement increases substantially or not. Similarly, you can see I'm doing it for Nifty. You can see for Bank Nifty. You can see for any other thing you want to see, right? Now let me put 10,400. Remember 10,200 we required 53,300 something something, right? Let's see 10,400, 200 points above 10,200. Let's see what is the margin requirement. 63,849. By coming up by 200 points, the margin requirement has increased by more than 10,000 rupees. Got it? The margin requirement is increasing. So depending upon which strike price, if you are selling options which are closer to strike price, your margin requirements will increase and the premium receivable will also increase. But why the margin requirement is increasing? Margin requirement is increasing because when I'm coming closer to the spot, any moment in the market, my position becomes much more riskier compared to a position which is far away from the spot. To cover that risk, the margin requirements have now increased. But if you're selling options which are pretty far away from the spot, there is no increase in the margins. So you must keep this picture in mind whenever you are creating an option strategy and whenever you know that okay, that option strategy requires some adjustment, whether that adjustment will require some additional margin or whether that adjustment will be helpful in releasing some margin, and ultimately with these techniques you are able to manage your overall investment in options trading. Hope this video will be useful. We have done it in the live session today, but because of some audio quality we are redoing it, right? Hope all your doubts are clear. If you have any doubts, please feel free, feel free to write those doubts in the comment section so that we can answer is at as quickly as possible. About our workshop, we have next online workshop on 17th and 18th November. This online workshop, sorry, this online workshop will be live. It will be from morning 10 to evening 5, both the days 17th and 18th, and you can ask your questions. It will be totally interactive. It is same as what offline workshops we are doing. So there is no difference. Only difference is we are not seeing each other face to face, but it will be live. It will be interactive. 17th and 18th of November. We wanted to do this workshop in Bangalore, but due to some reasons, we are not able to do an offline workshop on 17th and 18th of November. So most of the workshops in coming months, maybe in the month of November, December, and January, will be online. So if we should attend online workshop, you must enroll for this workshop, uh, wherein we are talking about all these concepts and different trading strategies with proper adjustment plans. You can contact us at these numbers. You can write to us at info@theoptionschool.in for getting more details. And sooner you do, better it is, because in online it is very difficult to take more participants. We take very limited numbers, and people who enroll first will be eligible for some early bird discounts also, right? Hopefully, we have clarified your margin calculation doubts. We are getting a lot of queries for that. Hopefully, these are now clarified, but still feel free to write any question you have regarding this in the comment section, right? Do not forget to like these videos. Once you like these videos, it will be helpful for us to bring whom you think this video will be useful, anybody who is interested in options trading. And if you have not subscribed to our channel, please subscribe to our channel so that whenever we are creating a new video, you are getting the timely notification. And if I'm not wrong, when you subscribe to the channel, you must press that bell icon so that you get the notification at the right time. Thanks for being there and have a great day.